Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for July 7th, 2021. And we're continuing our series that we're doing on dividend stocks. So remember, we did a screen for high-quality dividend stocks that would kind of fit the structure of the triple income wheel strategy. And so we're doing just a series that over the next couple weeks that we're just highlighting, the dividend stocks, which, again, dividend stocks work really well with this strategy. Remember, if we get assigned a stock and we have to hold it for a few months, dividend stocks work great because they tend to be less volatile, and you might be able to catch that dividend as well as getting covered call income, et cetera. So they do work really well with the triple income wheel strategy. So let's take a look at our trade today, which is JPMorgan Chase. So you can see it sold off yesterday, and we've had, again, this jockeying back and forth with both cyclical stocks and some of the growth tech stocks, and it's really all been driven around interest rates. So the banking industry and JPMorgan in general is very sensitive to interest rates, and it's moving quite a bit based on that. Personally, just the higher kind of qualitative analysis here, and we'll get into some of these other things. But I believe that interest rates will be increasing. Although rates have come down since they even announced that they would be raising rates in a few years. Rates have kind of trended down, and so you can kind of see when we'll look at the chart in a second that the banking industry or sector, and including all the major banks, have come down a little bit. So they've sold off a little bit. We like to sell into weakness, but if you just think high level, what we're trying to accomplish here, with this kind of dividend stock series is, if we take a stock that, say, earns 2 to 3% a year, can we manufacture a dividend that's 3 or 4 times that, through the options? And if you can find a stock that is kind of on the lower volatility spectrum, like a JPMorgan, right? We've got a mean volatility of 24%. That's pretty low, right? And we got a volatility risk of 8, which again is in the green. So it's a positive metric here. Which is leading to a required margin of safety of 6%. So that's kind of on the low end of what we would look for. So if we can find a stock that maybe has some tailwinds, like I think the banking industry does, because I do think interest rates will start to creep up. Now we need the economy to be strong, right, or at least stable. If the economy is stable, we have a rising interest rate environment, I think the banks do well, and I think you can literally generate 10, 12% on a stock like this, even if it doesn't move much, right? We just need that environment to kind of persist, and I think it'll be there, and hopefully over the next 12 months we'll kind of see that. But that's kind of high level thesis, and you always want to think about that as you're getting a stock into the wheel, right? And we always talk about building this well of stocks that you come back to, consistently to sell options on. And I think this is a perfect stock, to have in that, again, that main master watch list that you have for stocks. Because, again, I do believe it's one that you can go back to over and over again. So high level rankings, you can see we've got a 10 ranking on our dividend. So this is the highest ranking we have. Our rankings go from 1 to 10. But in general, we got above average rankings across the board, even momentum, which, typically value and momentum are, inversely related. But anytime you have a stock that's, valued appropriately and it has good momentum, I think it's a decent stock to, certainly have on your watch list, right? And like I said, the stock has pulled back a little bit. Already, we're down about 8.5% from the high, but it does report earnings next week, so that's something we need to take into account. But banks in general haven't been moving much on earnings, so I'm not expecting a huge move. But what we do is that we have a little bit of extra premium in there if we sell puts right now. And again, very extremely liquid stock. This was one one of the filters we had on our list was liquidity, and so it's a very liquid stock and a very liquid option contracts with this stock. So we're looking at a strike zone of 137 to 144. So let's take a look at the chart quickly, and we will kind of go from there. So you can see, I mean, we've had a huge run, even if you go, and it's crazy to think that this stock actually traded down in the 80s, back during the pandemic, but it kind of went sideways up for a little bit and then just kind of really started skyrocketing at the end of last year. And we're up, the stock was up 50-60% in a pretty short period of time, but rightly so. I think the economy found stability, which again, the banking sector will do well in a stable economy with rising interest rates, and I think that's what was being estimated here, the last 6 months. And so now we're getting a little choppiness because now there's some there's some other things to consider here, whether or not the Fed tries to slow the economy down or not. But again, a rising interest rate environment, these companies should do very well. Balance sheets are strong, and we'll kind of take a look at that. But again, strong uptrend. But what I'm looking at just short term, again, because we have our high level thesis long term, but for the immediate put that we're selling, right, we want to make sure that we have this balance where hopefully we don't get filled, right? We don't want to get filled, but we're picking good stocks that if we do end up getting filled, and if we do repeat this process over and over again, it's likely that at some point you're going to get filled just based on broad market dynamics, right? If some of these stocks sell off when we have a 10% pullback, we may get filled on a couple, right? And we want to be in stocks that we like, but we always want to look at kind of short term levels here. So this level that we hit kind of back in mid kind of April timeframe, it's like the 147.5 level. So you can see that last month we tested that and it held. And so that's kind of our near-term level that we're thinking about, right? And so thinking about our, where are we at? 137 to 144, right? So I knew we were below it, but just want to kind of check there. So 147.5 is kind of the short-term resist or support level, and then we've got the 144 is the top end of the strike zone. So yeah, I like seeing our support levels above our strike zones because that just gives me comfort. If we can find an option that we can sell in our strike zone, it gives us comfort that we have that additional support up above. So let's just take a look. I just want to show you dividend summary for a minute, because anytime you have a dividend of rating of 10, or any high rating, you kind of want to take a look and see why is this stock ranked so well. And this truly is a great dividend payer, and obviously we're doing this dividend series, and it's good to just kind of point out some of these things as we go through it, because the reason why we do these trade of the days is to really just help you go through some of the information that we look at, and it's helpful to know again what some of the things factors that go into these rankings really are. And so these are literally all the things that go into our rating. And so when we say it has a rating of 10, well, why is that? Let's take a look, right? So decent yield, I think above 2 right now in this environment, I think is an okay dividend stock yield wise. And then if you look at this, since the credit crisis, I mean, these banks have just been raising their dividends like crazy. So it's got 10 years in a row now. I mean, you can see last year it raised 9%, but look at this: the 5 and 10 year compound annual growth rates are huge. I mean, to find a stock that's increased on average 33% a year for the last 10 years, I mean, that's incredible. And on top of that, still having a low payout ratio of 27%. I mean, that right there is epitome of a good, solid, dividend growth payer. So that's why it obviously has a ranking that high. So just want to point that out. But let's take a look at, again, earnings. You can see sales didn't really dip for the banking industry, but earnings did. But you can see now that, earnings are vastly higher in 2021. We're well above pre-pandemic numbers there. And so we'll kind of see if, that can continue, in the future. And so let's look at, again, we're doing August. And, we'll look at a few different scenarios here that we can take a look at for our base, conservative, and aggressive portfolios. So again, on some of these dividend stocks, you're going to have lower volatility. And so, you're not going to have, the huge margins of safety, and really probably not that many, options that kind of fit into your bucket. So, what we're looking at here, obviously, is average monthly yield and margin of safety, and then our delta. We're looking for a delta below 30, and an average monthly yield of around 1%. And so ideally in the strike zone. So you can see the strike zone here is 144. So this 145 is slightly outside of it. And so obviously I'll make an exception. Sorry, I got rid of that. I'll make an exception on stocks like this that I feel are pretty stable. So let me put those back in. And so, right, we got, so the 144 would be just below this 145. And so I'm okay going up to 145. Obviously we can sell it for $1.85 roughly. So, at least our cost basis, our break-even point would be in our strike zone. So that's one thing to always consider too. As you look at, stocks that are maybe slightly out of the strike zone, if you can get, if you include the premium you get, right, because we get that regardless, it's going to lower our cost basis in this case, to 143.15. So that's in the strike zone, right? So that helps make that decision for us. But you get 0.9%, 5.5%. Margin of safety, and then 24. So you're not going to find too many stocks that report earnings next week where, this is kind of the profile. But again, these banking stocks have not really moved much. They move more on interest rate fears than they do, I think, really with earnings. And I think, kind of depending, Jamie Dimon is as good as they come as far as, management teams go. So, he's probably going to be pretty bullish just on the industry in general. He typically is, and he does a good job at that. So I don't see anything, big in the earnings call that would potentially throw this off too much. And the option market is literally, thinking the same thing, right? So that's why we feel kind of comfortable with that. So that's where our base strategy is there. And then for conservative, again, we'll go down. Again, this kind of meets our criteria. Again, about 0.5%. A little bit bigger margin of safety, which is nice. Obviously in the strike zone, and then we've got a delta below. We got a delta below 20 there, which is good. So I did scroll down a little bit too much because the one I was targeting for, and I'll just compare these for you here. The one I was targeting for the aggressive, you could do this not that one. You could do this 150 right here. But again, not much of a margin save. So looking towards earnings, and and I know what I just said, that it's probably not going to be much of a move, but 2.2% doesn't make me feel great at 1.5% monthly yield. That's on the low end of what we would want on the aggressive side. So this is one opportunity where I would say it's okay to trade the weekly options. I typically will just stick with the monthlies. They're more liquid, things like that. But the only time I will go with the weeklies are if I'm trying to target a certain time frame that maybe the weeklies meet and the monthlies don't, or trying to target a specific strike price. And so in this case, for whatever reason, this weekly option that expires a couple weeks prior, to this August monthly, you can get the 149 strike. So it gives us $1 extra, I think is kind of key, but it gives us we have the same average monthly yield, but we just get slightly higher margin of safety and slightly lower delta, right? And so that, just going into earnings, again, average monthly yield is the same. And this is the kind of analysis you go through, right? I mean, if all else being equal, if you have average monthly yield the same, and this is only for folks that are going for the aggressive side, because, again, this is not much of a margin of safety, but, you got your same monthly yield, but this one gives you a little bit extra margin of safety, a little bit lower delta. I think you go with that one, all day long with when you're comparing those two. So that's our aggressive one. And again, down here, this was our base, and this was our conservative, right? So that's JPMorgan. Again, I think this is a stock that we can hopefully continue to write these over time, and eventually over the course of, say, 12 months, get a 10 to 12% yield on a stock that currently is only yielding 2.5%. So that's how we do the wheel to, again, 3 or 4 times increase our income 3 to 4 times. So that's our trade of the day. Take care.